How long do we spend every day? Like half a day?
Yeah, basically half a day.
Half a day, yeah. Cool. About half a day and
Yeah, yeah.
doing well. It's fun. It's a very good class.
I mean, that's the thing. It's sort of just a sort of positive environment that's focused on learning. Yeah, that's the thing.
There's incredible I almost feel bad.
Yeah, I mean, they've got some of those things. But I feel like a lot of they've also got things. No, they've also they do a good job. I think of sometimes just showing the goal. Like here's something part of the analysis of the company. Like I just like the inventory turnover or something. We're not going to make any recommendations here, but just here's something. They do have some of that good a little bit.
Right.
Yeah, but, yeah, exactly.
Yeah.
Absolutely. Yeah, yeah. Gotta make money somehow.
How did you shop like money?
Like Molly Pool. I think they do subscriptions. They've got, I think they do some investment advising too.
Yeah, now they actually have EMS management.
Yeah, that's right.
See, I always wondered, these pure research shops, what are they, I shouldn't equity that was a part of the investment. They're standalone research shops. I don't know how they, they don't have a trade.
Molly Pool before was standalone research on security.
Yeah.
That's how they make the money.
They had like what, a dozen different little hidden gems, like small cap ones, international ones, all these little buckets you can subtract.
But now they have a couple different things. So they have the newsletter, and that's the webinar separate.
Yeah, yeah.
Portfolio, effectively, advisory service. So they're telling people, here's what we're doing.
Yeah.
Starbucks. And they let them trade ahead, and then constant trades after that.
No, it doesn't happen now.
So it's sort of an advisory. Here's what we're doing with our portfolio.
And
You're free to follow or not.
Those $1 million, are they investor money or is it?
That's inside capital, balance sheet capital. Yeah. So it's sort of the hybrid between the asset management.
Are they considered advisory? If they just say,
Under the
this is what we're doing, but we're not.
yeah, probably not. Or I don't know.
They're probably trying to buy that, being ready for it. Because if they're just managing it, they're not going to a lot of recommendations. And if you're just telling them, these are the trades we're doing, we're not going to do recommendations, but we're follow.
Yeah, so I don't know how, one side of the house they absolutely are.
Right.
And that side of the house they're not. But I don't know what the regulations are when you have balance sheet capital, yet you're telling people for your newsletter, so I don't know. You're going to talk to them about the specifics on that.
Yeah, I saw one that said, this is where we have $100 all the way to our money invested.
So that's probably another one. So the guy, Ron Rose, who comes to the bar, he calls it. That he won't sell the fund. So, yep.
All right, we're back.
Cool. What does the laser? Is it the red button?
It doesn't work on this screen, it only works on the other screen.
Oh, whatever. I don't need it. It's all right. All right, good to go?
Whenever you're ready.
All right.
All right, let's get started.
Hey guys, today I'm going to be doing my stock pitch. I am pitching that we sell Bonanza Creek Energy and that we buy Intel. So, jump right into it. My main investment thesis for Intel is that they have a solid dividend yield of 3.7%. Investors have been overweighting the declining PC demand, which is a big part of what Intel does. They have a very cheap valuation currently. They're shifting their focus towards high-growth markets such as tablets and mobile processing, and they have a very strong balance sheet. Bonanza Creek Energy is it's a big shale oil play story. They're running out of momentum. They're up something like 180% year to date. Recently, actually, the stock's experienced about a 10% pullback, really due to the volatile oil and natural gas prices of the past month. There's minimal margin of safety associated with Bonanza because they don't have a dividend yield, and they're a relatively small new company. They only IPO'd 2 years ago. So talking about Intel, Intel designs, manufactures, and produces and sells mainly processing technologies, but and their main focus is in microprocessors for PCs. PC sales account for about 60% of their revenue currently. and they experienced 35% margins on their PC sales, which is pretty solid. A big story with Intel is that they've been late to the mobile processing market, and they've allowed competitors to kind of establish themselves without really challenging them. So that's a big criticism, and they've been mitigating the effects of the declining PC demand by kind of trying to enter and establish a foothold in these markets, such as cloud computing, tablets, and mobile processing. There is evidence showing that the rate of decline in PC demand is actually slowing. IDC estimates that the rate will pretty much level out by late 2014. And Intel is very heavily invested in production facilities that aren't being fully utilized currently. And so I give their business a B+. For management, they had a recent change in management. Brian Krasnich is an Intel insider for over 30 years, and he's their new CEO. He has a lot of experience with the manufacturing side, but there's kind of some uncertainty in regards to his management in tough times, and he's had such a short tenure. Additionally, the management at Intel has been investing heavily in research and development over the past 2 years, so they haven't been as focused as pleasing their investors' earnings growth rather than focusing on positioning themselves to succeed in the future. They've always been rated as one of the stronger corporate governance boards, and just throughout history, Intel's a very recognized brand, and they've been managed well throughout the past 12 years. Moving on to their balance sheet, they have a very strong balance sheet. I believe they finished the third quarter with something like $8.1 billion in cash. They've been growing their R&D heavily, as I mentioned, over the past 3 years. Their assets have been growing, and they maintain a very low debt-to-equity ratio of about 25%, which makes them a very low liquidity risk. Additionally, like I mentioned, they've been focusing on R&D, so that hasn't really, investors haven't seen the type of growth and income they've been accustomed to seeing from Intel over the past 2 years. So it's trading at a discount. Moving us into our evaluation. It's trading at a price to earnings of about 13 times, might be a little less now, making it one of the cheapest broadline semiconductors. And it's actually, compared to the industry, it's fairly cheap compared to its competitors as well. Their price to book ratio is also fairly cheap, of about 2. And they've always had very high free cash flows, which has helped them pay out such a high dividend yield throughout their time as a company. So that provides a substantial margin of safety. 3.7% is a pretty serious business. So kind of looking at technicals and where the prices have been going recently. As you can see that since bottoming out in 2009, it's been supported and path of least resistance is up. Kind of looking at a more current picture, we see that it broke out recently above this. It started making lower highs, but we were reassured in late October when the third quarter results came in, and they still traded higher. It's actually it's pulled back a little bit in the past couple weeks, but I think it's trading about 23.50 currently. Talk about catalysts versus risks. Intel is actually opening up pop-up retail locations, kind of just to spread its brand name and kind of show consumers what they're capable of selling. So these are going to be, I'm pretty sure there's going to be mainly located in New York City. Additionally, as I mentioned before, their current manufacturing facilities aren't fully utilized. I believe they're operating at something like 65% full capacity, so we have a lot of room for economies of scale if they can generate the demand. Additionally, once they establish this new revenue mix of exactly how hard they're going to target the mobile and the tablet markets, we'll have an idea of how they can reduce their fixed costs. Additionally, what is it called? I think it's the data center group, which is mainly focused on servers and transferring large amounts of data, is actually growing heavily. They currently, I think it accounts for about 22% of their revenues, but they boast gross margins of about 55%, which is very solid. Risks. So the biggest risk to Intel is pretty clear. It's the death of the PC. Intel's very heavily involved in the PC market. They always have been. So the biggest headwind they have is this idea of declining PC demand. People don't want to use PCs anymore. Additionally, like most other firms, they're exposed to global risks and non-firm specific risks. And another potential risk is they could lose their competitive advantage in processing technologies. So overall, final score is an A-. So now let's jump into the sell. So Bonanza Creek Energy is they're an Indian oil and gas company here in the United States with mainly 2 locations. They IPO'd in 2011, I believe, and the run-up for the stock has been very solid. They've repeatedly beat earnings, and they continue to trade higher. Something important to note is that there's weakness. Oil is trading at a very low price currently compared to where it was at 7 or 8 months ago, and that directly affects obviously a company like this. It makes them more exposed to global economic weakness, and it kind of makes them really vulnerable to a demand shock. And a volatile environment also makes it difficult to build new infrastructure, even though they've mainly been focusing on expanding their operations in their 2 locations. In regards to management, they've had a lot of experience. Bonanza's been private, I believe, since 1991, and they've done a good job running the business. However, they haven't really been focusing. That's a typo, by the way. It's focused on earnings rather than expansion. So they haven't told us where they plan on opening their new locations in the coming years. They're very focused on their 2 existing locations, which are one is in Colorado and one is in Arkansas. Additionally, there's been unprecedented inside selling since July, very high levels. A good thing about their management is that since they do only have 2 locations and they have a lot of experience, they're very successful at controlling their operations and reducing their costs and operating effectively in existing locations. In regards to the balance sheet, they're taking out a lot of debt. Quick ratio of 0.5. They're a short-term liquidity risk. I think it was 2 weeks ago, they issued more senior notes to expire in 2021 at an interest rate of 6.75%. So they're taking out even more debt. Their price-to-book ratio of 3 is higher than the industry average, so they're a little pricey. They've had constant growth in retained earnings and growing inventories, even though you can't assume that it hints of a surplus or it hints of a lack of demand, but it could just be because they're revving up their production to such higher levels. So I'm going to give the balance sheet a B-. In regards to the valuation, they lack a dividend and they lack a margin of safety. They've been exposed to the shale play, which is why they've been so successful. They've been a really good story. But given the volatile fundamentals and the volatile nature of the natural oil and gas market, future earnings are very difficult to predict. And that's why the short float for this company, although it was a little higher 2 weeks ago, it's dropped substantially since it pulled back, was sitting at around 10%. So looking at some charts, we see you can see it's been trading higher, and it kind of topped out at 55, and we broke down, and we've actually traded even lower. So that's a sign that maybe momentum is running out, and now's the time to get out. So overall grade is C+, with a B for business, B- for management, and a B- for the balance sheet, and a C for price. So this is my overall thesis. Does anyone have any questions?
Questions? Can you elaborate a bit more on, you mentioned Intel late to the mobile game.
Right.
Maybe elaborate a little bit more on what progress they're making there. And how competitive or not competitive maybe they are with ARM.
Yeah, so ARM is a good example of someone that's successfully taken away and established a market share that Intel would love to have. The mistake that Intel made is it didn't target these markets aggressively enough to begin with. So now it's much harder to get in with all of these companies that have deals with Apple and with all the mobile phone manufacturers. But there is potential in the coming years because Intel is they're showing that their microprocessors are more capable than these, although they're a little bit more expensive, they're more capable and they're just better than the processors out there right now. So the problem is really reaching out to these companies that sell the mobile phones to kind of come to an agreement with them. I know Apple's having a lot of problems with Samsung, so maybe that's a window of opportunity. If Intel could step into that would be pretty solid too. Any other questions? Yep.
You may have touched on it earlier, but how dependent is Intel on the desktop segment for revenue? And if there is decline, how would you go about quantifying what that might be on a very broad scale?
Well, so the thing is, are you saying like drastic decline or pretty much decline in line with what's been happening?
I know there's been a pretty constant decline in PC shipments.
Right.
But it hasn't been drastic to my knowledge.
Mhm.
I guess.
It's slowed down a little bit recently, actually. What's good about Intel is that they're fully exposed to all of the PCs that are sold, pretty much. They have a very high market share in the field. So they're taking advantage of everything that's there, but the problem is what's there is becoming less and less every year. They've actually, I think they've actually done a good job. Their forward guidance for the next year is about pretty flat, so they're setting expectations low. So given how drastic the actual decline is over the past 3 years has been in PCs and how Intel's kind of combated that and kind of stayed afloat and continued to reinvest and pay out its dividend, I think it's not going to get any more drastic, so in my opinion, it could only get better after this. Thank you. Cool. Thank you, guys.
Oh, I can see myself too. Sweet. Good to go? Yep. Awesome. So my name's Hunter Pritchard. And I'm excited to pitch the Phillips Student Investment Fund. My recommendation is to buy Deere & Co. and to sell Big Lots. Start off with an agenda. I'll go through my buy rationale for Deere & Co. and then jump into my sell explanation for Big, and then answer all of your questions. My rationale for buying Deere is, first and foremost, the machinery industry is one of the most attractive industries in the United States, and it is looking at great expansion around the world. Deere specifically has attractive valuation relative to its growth potential. It's had a lot of growth in the last few years, and its valuation isn't reminiscent of that. It's also looking at new partnerships and opportunities in the technology field, and especially bringing those technologies to the machinery that it produces. And I think that's unique in that I didn't find that with a lot of its competitors. Its earnings 5-year growth is pretty stable and increasing, and is set to increase over the next 5 years. And its market capitalization is about $31 billion. It trades at 11 times earnings, despite its double-digit increases in both earnings and revenue. For Big, I go into a few more details other than the two on the board right now later. But first, we own Costco, and it's performing a lot better than Big. And really, with coming out of the recession where Big picked up a lot of customers, it's starting to lose its customer base and its traction, which I think it will really hurt in the next couple of years. So starting with Deere. Deere is a market leader and definitely has dominance in the spaces it plays, but it is a fragmented market, and there are other companies such as Caterpillar that really are competitive towards Deere. It plays in 3 spaces. First, agriculture and turf, and construction and forestry. It's really building the machinery for both those industries. And then its financial services support to the machinery that it sells in the other 2 industries, and allows it to really continue to sell it and be a big player in the game. It sells its products through independent retail dealer networks and retail outlets. So that's a little bit about the company. Some of it's more number side. Over the last 5 years, it's seen its revenue increase of $7 billion, which is pretty impressive since we were going through a recession and a lot of the markets that it sells in were being hit pretty hard. A few things to point out. Its price per share as of this PowerPoint was about 82. It had a big jump today. It's trading at about 85, a little less. And when I kind of went through some of the valuations, I got to about 88, between 88 and 89. And then some of the analysts that I was looking at from a couple of the big banks were valuing it at around $95. So it definitely has potential, as seen in its 5-year growth estimate. Its PE is around 9. One thing that really stood out to me was its gross profit margin at around 9%. That was really good for the industry. but also that they're focusing on widening that and really getting more bang for their buck. And that's kind of what I said below, where they're reducing the percentage of sales devoted to cost of goods sold. And in the latest earnings call, they really focused on that and driving down costs and increasing that bottom line, which they've increased about $400 million over the last few years. Sales per employee also was very good, $500,000 per employee. It's got over about 70,000 employees, so that was pretty impressive for me. Comparing it to its industry, according to the IMF, as I mentioned earlier, the machinery industry is one of the most attractive industries in the United States. It's a very competitive industry, and all the different players are facing the similar risks. But what I think really sets Deere apart is its global expansion. And I'll touch on that a little bit. But a lot of its competitors' earnings are plateauing, and Deere's got very good potential over the next 5 years and into 2020 as well. Looking at the framework, just to touch on a few of these things, so the framework's on the side and then my grades are on the right side. I mentioned Deere is exploring new partnerships. I really think that sets it apart from its competitors. Human food consumption is increasing. World estimates are that we'll hit 9 billion people by 2050, which is an increase of 2 billion, and therefore, in order to meet that supply, you need the machinery that Deere sells. Its executives seem to be at Deere longer than a lot of its competitors, and Deere has been very good at withstanding a lot of the contraction that's gone on in the industry and really continuing to be at the forefront as a market leader. Current price, I said, is about 85, so it's on the higher end of its 52-week high-low. And overall, I mentioned that it's really undervalued. Going on, just to touch on a couple other things, I mentioned that the global outlook and the tailwind, the macroeconomic tailwinds, emerging markets are really a place where Deere has capitalized on and is continuing. One of its biggest competitors, Caterpillar, had a real stumble in China over the last 6 months, and Deere has kind of moved in with its brand reputation and taken advantage of that. And then also in the U.S., the USDA forecasts that farm growth will increase 6% by the end of 2013 and into 2014, whereas farm growth has been very stagnant over the last 4 or 5 years, and that really plays into Deere's strengths. And Warren Buffett and Bill Gates both own sizable shares in Deere, so I thought that was cool. Key risks, the only thing that I really wanted to touch on here was that if it stumbles in global expansion, especially in emerging markets, it could really see some problems in continuing to maintain its, or in continuing to grow its revenue, but it already has sizable revenue, so that it will just kind of plateau. And the margins of safety is its business model and growth potential. So sell Big Lots. Big Lots is an off-price retailer that kind of discounts a lot of its products, and that's why I think we've really capitalized on Big Lots over the last few years within the portfolio, and it's time to sell. It's overvalued, and I think that's what, if you look today, Big Lots is sold off about $2. So it's starting to really come down because it's losing its customer base that it took advantage of over the recession. Sales, if it continues to decline, it's going to push its leverage up and gross margins will fall, and then the stock price will fall. It's lost sales in electronics and also in food and clothing, some of its staples. So I think that is signs of weakness. Its framework, I gave it a C overall. As you can see, When I was going through and trying to value it, I was valuing it at about $32, and I could almost get down into the high 20s. It's currently at like 36-ish, and it's come down $2 over the last 2 days. It really faces challenges in maintaining and strengthening its customer base, as I mentioned. It took advantage when, during the recession, when people wanted to get more bang for their buck, and now people have more optimism in the economy and are spending at higher end retailers, and therefore Big is getting kind of squeezed out. Its credit rating is BBB minus, and that in a recent earnings report and call could go down if it can't maintain its same store sales. Sweet. So with that, I recommend that we sell it. Based on that, I think we've made a good chunk from it, and it's a time to get out because it's just overvalued. And as the economy bounces back, Big is going to really get squeezed, kind of like other discount retailers like Circuit City or some other players that have gone out of business. So with that, I recommend buy Deere and sell Big. And then questions. Yeah.
So the boss, they're still using customers. Do you know if they're trying to do anything to retain their customers, any initiative or anything like that?
I think I couldn't find anything with regards to maintaining it other than continuing to find deals and products and therefore sell goods at value. But I couldn't find anything like any marketing initiatives or anything like that that was really different than what they're already doing.
This might be kind of loaded, but do you know the difference in, you say Caterpillar stumbled internationally?
Yeah.
Do you know what Deere is doing differently to them to avoid that?
Deere's really trying to build in some of these markets based on its brand name and its reputation within the machines that it makes. Caterpillar had fumbled the ball basically in terms of dealing with the government and in China. I'm not sure exactly what happened there, but Deere is going to the market and really taking advantage of this strong reputation it has. I don't know if that answers it completely. But
I see on the 600 big lots, there's $150 million in loans. Are they expanding anything, or is it just losing like there's nothing?
Yeah, it's really insignificant. I didn't see that I couldn't find anything with regards to like forward expansion into Canada. It seems like they just have a few here and there, and that there was no long-term growth into Canada. Yeah.
Any question? All right. Thank you. Okay, going forward here. CBS. Did everyone get the executive summary? I did.
Okay. All right. Hello, everyone. I'm Jake. I'm presenting that we buy CVS and sell Best Buy. So CVS is a pharmacy healthcare provider. They also have retail outlets and online stores, well, an online website. Pharmacy is by far the biggest segment. It's worth 68% of their sales. And their market cap, well, at the time of this, was $79 billion, PE of 20, which is right in line with the industry averages. They're in the drug retail industry. Yep. So this is their stock chart. As you can see, it's a pretty steady increase. I mean, granted, most of the markets have been doing it similar to this, but CVS's stock price has been fairly consistent with rising not many dips. Overall, so CVS's biggest competitors are Walgreens, Rite Aid, and GNC. And between CVS, Rite Aid, and Walgreens, they control over half of their market share of the industry. So drug retail is extremely complementary to the pharmacy industry and healthcare industry. in that most people will go to these stores to get their drugs. And given that the pharmacy and healthcare industries have been rising very rapidly, as it's one of the fastest growing industries in the world, definitely in the United States, and drug retail has just been tagging along right with them. The PE and debt equity are right in line with the industry averages, and it's so the reasons to buy, CVS is a very strong core business. Their pharmacy business line has been extremely successful. Since this presentation, they've acquired Corion, which is an infusion therapy and nutrition services company. It's going to expand and diversify their pharmacy business, and it's expected to bring in $1.4 billion in sales in the first year for a $2.1 billion acquisition. Again, the healthcare industry is one of the most profitable industries today. They have growing margins and lowering costs, especially with the United States has an aging population, which is only going to increase demand for healthcare services. And of course, the stock price of CVS is steadily rising, and they've repeatedly beaten analyst expectations. I think they've beaten 3 of the 4 past quarters, and that's not including previous quarters. The valuation sheet of CVS, it's at the time it was $64. Right now it's about $66. They've got $1.4 billion in cash, almost $10 billion in debt. Their margins have been doing very well recently, and in the executive summary, you can see that it's only expected to do better. The potential risks of CVS is that if there's any unexpected regulation of the healthcare industry, especially with all the troubles with the Affordable Care Act, there's political risk basically for every industry in the United States because it's such a gridlock and there's a lot of unexpected. No one knows exactly what's going to happen with the healthcare industry. It could go either way. If there are any rapid advancement in drugs, it could harm CVS margins if they have to acquire rights to more and more drugs, whether they're generic or patented, then that could hurt our margins. If there's any new regulation regarding Medicare or Medicaid, whether it gets cut, defunded, or if there are changing requirements, it could hurt CVS's business. And finally, the CVS stock price is high for its industry, which could be a problem. But CVS is also one of the most successful companies in the industry, so there's much less risk regarding whether or not there will be unexpected dips in their business. So moving on to Best Buy. So the company overview, it's in the community services retailer. I'm sure you all know it's mainly focused on electronics, appliances, home office products, and entertainment products. They have a market cap of $15 billion. They've had negative sales growth for the past 2 years and negative net income as well. So this is the sales mix of Best Buy. As you can see, computer and mobile phones are the largest business segment. The past year, they've had a 0.1% increase in their computing and mobile phones segment, but the next 3 largest business lines all have had a sales decrease between 15 and 18%. This is a stock chart. The dip by the end of 2013 was due to the issue of showrooming. This is when it first came out. I think they had an 11.1% sales decline in that year, which shocked analysts, causing a heavy dip. Best Buy has been trying to address this. They've been saying they're addressing it, but as I'll explain later, I don't think that they are. So some of their main competitors are Amazon, GameStop, Radio Shack. Best Buy is the largest store retailer, but online stores are the biggest concern of Best Buy. Other brick and mortar stores are competitors, but their biggest threat are stores such as Amazon and eBay. They do have the industry is very saturated within consumer retailers. Best Buy used to be so successful because they were a cost leader, but due to online stores becoming much more prevalent, they're able to have much less expenses than Best Buy, hence they've lost their cost leadership, which was their competitive advantage for why they did so well. So the reason to sell, the holiday season is going to put on added pressure for their margins, which is only going to hurt them even further. Showrooming is still, by and large, their biggest concern. Obviously, Best Buy is no longer a cost leader. The management has been talking about addressing showrooming, that they have plans to fix this, that it's a thing of the past, but I think it's all talk. I don't think they're going to be able to do this. They've tried to do an initiative where if you shop, you can check online, and if you can find a lower price, then you can buy something in store at the same price, but they haven't instituted this nationally, and as so far it has been minimally successful. Internet purchasing continues to increase. I got the numbers from this past weekend. Cyber Monday web sales rose 21% from 2012, mainly through eBay and Amazon. Online spending increased 15% to a record $1.2 billion on Black Friday compared to last year, whereas in-store weekend sales fell 2.9%. And so the National Retail Foundation did some of these numbers, and they expect that internet sales are going to rise more than 3 times faster than total retail growth in the coming years. Finally, Best Buy also has been much slower than its competitors to increase their online market presence. So you have other stores, because retailers that have their online websites where they'll sell, and they've been doing a lot better than Best Buy in terms of getting this up and running, making it easier for customers to just shop at their online website as opposed to going into their stores. Finally, the industry as a whole has been rather lackluster. They had a 0.2% earnings growth in the past quarter, and their growth has been slowing consistently. Just the valuation of Best Buy, their price has dropped to $42 today. Their cash and debt has been pretty consistent, but their revenue growth is very poor. They're continuing to be negative in the net income, and I don't see them having a positive earnings in any of the coming years. And obviously their earnings per share is negative due to the negative net income. The potential risk is that the industry is very sensitive to overall economic health. So if there's rapid growth in the United States in the coming years, then this could boost the industry to do better. Best Buy could, in theory, successfully adjust showrooming. If they find a solution to this, then customers might start shopping at Best Buy a lot more and change their projected revenue growth. Also, if they do well this holiday season, that could boost up the Best Buy stock price, although analysts are saying that this season is going to be poorer due to this past weekend's sales as an indication for holiday sales. And finally, if consumer confidence or spending rises sharply, they're much more likely it's going to boost Best Buy numbers. The online sales growth is mostly due to younger people, 18 to 29. So if the older generations have a much larger spending income increase, then they are most likely to support brick and mortar stores as opposed to online sales. Thank you, and if anyone has any questions. Yep.
So I believe the CEO tried to take the company private. I think it was earlier this year. Do you see that as something that might happen in the future, if not the CEO of the company private, or for it to be okay?
I don't see Best Buy being bought by another company. Obviously, they do have the risk of, well, not the risk, but there's a chance that they would be able to successfully purchase it back. But given the turmoil within Best Buy, they've had new management coming in recently to try and solve these issues, especially after the past year. I don't see it happening anytime soon, and if it does, I'm sure it'll be very contentious. Yes.
I have a question about CVS. So the past, Rite Aid has outperformed CVS substantially over the past year, and it's still trading at a cheaper price to sales ratio. Well, what do you think differentiates CVS in the coming months from Rite Aid?
So CVS has a much larger presence. Overall, CVS has a larger presence. They obviously Rite Aid is a competitor, but it is a smaller company, so it's more subject to smaller shocks in markets. Whereas CVS is going to be a more stable company. They may not have as high of a growth as Rite Aid, but I do believe that CVS is going to be less risky than Rite Aid.
Is CVS the biggest?
Yes. And obviously it depends on which factor you're looking at, but in terms of stores, not market presence, but availability to customers, CVS is larger.
Thank you.
The FTC said yesterday this morning that they're going to be keeping a closer eye on the merger between CVS and Fairmont, so the equal relationship there, PBM. And then there's some other competitors that there's some evidence of coalition. If they were to take regulatory action, what do you think? Do you think that there's been enough difficulty in using some reserves that would be, that would fall faster for CBS or not?
So I'll be honest, I haven't seen the FTC talking about that. Obviously, it would depend on how far they go into regulation. I don't believe that the FTC would completely cancel the deal. So CBS would still be able to go through at least a part of the deal. And even if the deal is completely shut down, I made this buy recommendation before the Quorum acquisition, so I still believe that it holds, and it just wouldn't be quite as lucrative as it is since the proposed acquisition.
Other questions? No, thank you.
Thank you.
Two more.
Well, I hope my outrageous outfit can make my presentation more attractive.
I think it makes it more attractive.
Well, first of all, I'm proposing to buy Vornado, and it's a real estate investment trust. I just want to put this chart on the board so that I'm gonna explain more in the future. So assuming this is a capital stack of $100 million when we're buying real estate, and then 60% of it, $60 million, comes from debt, first mortgage, and then you have mezzanine debt, and then you have equity. So for Vornado, normally they participate in this portion and this portion. When they're buying a piece of real estate, they are either lending, selling their money as a mezzanine debt, or they're investing in equity to develop a site. So my thesis is, consensus recommendation that is always a buy, and then some of them say it's a strong buy, some of them say it's hold. So on average, it's a buy rating. The PE ratio is 15% higher than the industrial average, which meaning that the market has more confidence of investing in this company, even though the overall economy interest rate is not so beneficial. And the current property seller in the market, meaning that Vornado is selling a lot of their assets in the market instead of buying and investing. Just some highlights for their business. They focus mainly on New York and Washington D.C. They own 100 million square feet of office building. If some of you ever been to Crystal City, they owns a lot of property there. For another example of a prime asset is 1999 K Street, which is rented to a law firm. Those are some of the great examples. I'm gonna use the 1999 K Street as a case study later on in the presentation. And they recently closed a deal in Atlantic City, spending $80 million in cash and taking on 70% of the leverage, buying Borgata Hotel and Casinos. So just some highlights of their recent transactions. I was talking with one of their management and figured out that they have only 5 institutional investors contributing to their fund, and most of them are sovereign wealth funds. So that gives them maximum flexibility of making their own decision. And as some of you already heard of, people call Vornado as the hedge fund in the REITs world. So in terms of the management, they have strong leadership under Steve Roth. He's a real estate mogul, previously a member of Toys R Us, member of JCPenney. Recently, they got hit because of the huge loss on JCPenney, and they are still recovering from it. But overall, it doesn't impact the strong management and strong leadership of the company. And they really have a diverse investment strategy into different sectors. And I was mentioning briefly about they are a property seller in the market instead of a buyer and active investor, and that shows that this management is being very strategic in terms of where they see the market's going to go, and they're trying to cash out when the market is high, and accumulating cash, really looking forward, just trying to manage risk in the long term. In terms of balance sheet, most of the time I look at their interest rate coverage and as well as their leverage. referring back to this capital stack, when you develop a property, you have to take on a lot of debt. And if the overall income generated from the property doesn't cover the short-term interest payment, then meaning that borrower is defaulting on their loan. So for them, they have a very high interest rate coverage ratio, and most of the time they use 60% of leverage instead of 75 as what is common in the industry. And doing 75 leverage is actually quite risky in this time of the market. And in terms of price valuation, the market consensus have a $91.5 per share. Their market price currently is $88.98. I do believe there are a lot more growth potential in this company. In terms of estimates and momentum, EPS is forecast to drop by 1.93%, which is not a very positive sign. But in the meantime, I think the low conservative EPS estimates gives the company a better chance to beat the consensus. The company issues EPS forecast and earnings estimate, and if they are going conservative, then they probably have a better chance to beat it. Just referring back to the previous previous point. So I want to. This is actually from a report. I didn't do this. I was reading a lot of reports published by major REITs and investment consulting companies, and this is one of the slides from this organization called Tungsten. It gives you a very good sense of what's going on in the market in terms of GDP and employment, because Vornado is a very heavy owner of office buildings in the market. Employment means a lot to them, and if you look at the trend, the overall GDP growth, forecast growth is relatively sluggish, but the employment trend is forecasted to grow pretty quickly in 2014 and 2015, which is a good sign for them. And this chart shows you the different job creation contribution from different sectors. So here is high tech, and then is housing and lodging, and then I can't really see on there. And then later on is education and health, and leisure and leisure and healthiness. And then at the bottom line is construction. So overall, high tech industry is generating most of the job creation, followed by the rest of the sectors. So noticeably, the trend for employees in these sectors are moving back into the cities, which is a great thing for Vornado, because most of the properties they own is in downtown area, prime assets. So when people are moving back into the city, it means more market for them. Looking at the housing market, the total housing starts to recover, and right now we're at this point, we're at 2013. We're still below the pre crisis level. Looking at the NOI growth, so meaning that there are still a lot of potential for recovery in the market. And then looking at NOI, which is the net operating income generated from properties, is growing at a pretty high rate of 4%. So which is a great thing for asset holders like Vornado to further increase their source of income. And for NPR, for cap rates, even there are a lot of talking about how high interest rate, the growing interest rate will eat up the margin for real estate developers. But if we're looking at this chart, we still have 400 basis points above the 10-year Treasury yield. So even though the Treasury yield raised by another 100 basis point or 200 basis point, we still got a pretty good margin. And this is another overview of the apartments, industrial, just overall cap rate, NOI growth, and unlevered totals. This gives you a good sense of what's going on in the market. So the potential risks are the interest rate might rise faster than expected. The inflation might reduce the real value of the assets. Sluggish job growth might be another concern. And then macroeconomic risk in general. We just don't know what's going to happen in this market. There are a lot of risks. So my recommendation is to buy, and then in the meantime, I'm recommending to sell Costco. They do have a great model. I look into the company. I like their overall performance. It's very steady. It gives you strong growth. Their stock price chart performed very steadily over the past 4 or 5 years or so. But I hate to say this. I don't want to sell any stock in the portfolio. But the reason why I picked this is in wholesale business. The company is having a lot of challenges. Really, treasury hunt, high margin merchandises to put on the shelf, and in this very in this bullish market, we probably have different places, alternative assets to invest in to really generate higher return. So that's my presentation, and if you have any questions, just shout it out.
So I know Vornado had a stake in JCPenney that they sold out at a loss, and they also, I believe, hold a third of the stake in a private retail Toys R Us. Do you have any insight as to what those investments are going to, what kind of effect that's going to have on the returns of the company?
Well, I think they're actually in JCPenney is pretty good. I think that's a good call.
Well, they sold that out already.
Yeah, so that's exit. So I think looking forward, that's a good sign for the company. For toys, I think as long as they can, I think Toys R Us is pretty innovative in terms of their R&D and coming up with new toys. So looking at that perspective, and the whole point of this toy business is whenever you have a new product, you have a new toy that is bought by most of the people in the market, it's a huge profit margin, and they are this company is pretty good at their R&D. So as long as they can keep coming up with new toys to sell to the market.
So if Toys R Us were to IPO, would that be a good thing or a bad thing for Vornado?
I don't know.
Right. Fair enough.
Yeah.
Your macro data kind of look like we're at sort of an inflection point for things start getting a little bit better and everything. Wouldn't it be better for Vornado than to be a buyer right now?
Well, the thing is, when the market is really behaving very bullishly, everybody's rushing into the industry, and then that drives up competition. And when things are getting more and more competitive, people are lending at lower margins. They're lending at lower premiums. So right now, if you're looking at for a piece of property and there are 10 parties bidding on the same site, it's amazing that most of the people will come up with a very, very similar number. And when the business is getting very competitive, I think their decision is pretty good of exiting when everybody's rushing in, playing conservative in this industry.
So what do we want to buy if they're selling? What do we want to own real estate if they're selling it? Especially in their two key markets, New York and DC.
Can you repeat the question?
So they're selling assets in New York and DC,
Right.
which have done extremely well.
Right.
If they're selling real estate, why are we buying? Would we wait until they sell all their assets, they have cash, and then are looking to buy?
I think they're not selling everything. The assets they are selling, I think from the management point of view, is generating the least amount of income for the portfolio. I think when they are liquidating more positions and stock up the cash, I think the market is probably going to react positively for it.
Since they're a REIT, if they're selling all this stuff, doesn't 90% of their cash have to go to shareholders? Maybe I'm wrong on that, but since they're a REIT to not have to pay tax or whatever, don't they have to pay out most of the money they earn? So if they're selling, technically that
Right.
money's not there. It's sort of like a pot to wait till things turn around again.
I think they are going to reinvest the
Okay.
cash at some point.
Can you comment further on the Borgata acquisition? Did you get any additional color from the management about their ideas to enter the casino business?
I didn't. I was just throwing up there just for the point of just highlighting the recent activities.
Other questions?
We were talking about Costco. I know Costco's had a long-time commitment to the customers that they don't ever have a margin on any product above 14%. So when you said you thought that they should raise margins, were you referring to that they should change that policy, or that they should do? Because I know that's been a point of contention between them and the past.
Can you repeat the question just a little bit louder?
So Costco has always had a policy in terms of like their customer relations that they don't raise margins of 14% on any product. So when you were talking about higher margin products, do you think they should abandon that policy? Or do you think they should do some other approach?
I think that's a good point, and I see that's most of the challenges that where it comes from. If the company says we're going to reduce the minimum rate of return we're looking the margin we're looking at, I think the probably going to hurt their stock price. That's my point of view.
Okay, thank you.
Yeah.
Come on, please.
Should I start?
Yeah.
Here's a quick. Good afternoon, everyone. Today I am recommending a buy on Phillips 66 and sell on a government inflation-protected ETF. So starting with Phillips 66. By way of background, Phillips 66 is an independent refiner. It was spun off of ConocoPhillips early 2012. It's the largest independent refiner in the U.S. They have about roughly $180 billion in sales and $4.1 billion in net income, 2012. One thing that's significant about Phillips 66 and that distinguishes that company from its competitors are, well, actually two things. One is a chemicals company, which is a 50-50 joint venture with ConocoPhillips, and their recently launched MLP in their growing midstream business. So reasons to buy. First of all, Phillips 66, this is more of an industry play as much as it is a single stock play. The refining business, I don't want to go too much in detail, but margins are dependent on where oil prices are right now. And there's something called a crack spread, which is how much you can make off of 1 barrel of oil after refining that barrel into different refined products like gasoline. So the story coming out of the shale oil has allowed WTI, the U.S. benchmark of oil, to go down relative, and there's a relative spread with Brent. I'm actually going to go into more detail of a chart, but the difference between WTI, the U.S. benchmark, and Brent, the global benchmark oil, has been widening, and that allowed refiners here in the U.S. to buy crude from the U.S., refine it, and then sell it overseas based off of Brent prices. So the expectation is that the margins will continue to widen. CP Chem, that is a rapidly growing chemicals business. It has high returns, 20% return on capital so far. It's actually allowed for a more balanced business portfolio. You notice that, I noticed that third quarter of 2013, the refining business lost $2 million, but the overall company made roughly over $500 million. That is mainly due to the chemicals business and the midstream business. Now, if you compare it to 2012, when the refining business contributed over 90% of net income. So they have a more balanced portfolio, more balanced than, say, other refiners, and that allows for a cushion against the volatility in refining margins. We can also continue to expect a continued return of capital to shareholders. Since they IPO'd, or since they began trading independently in 2012, they've increased their dividend 3 times. And they bought 5 million shares in the fourth quarter of last year.
So there's a strong commitment by management to return capital to shareholders. Another advantage Phillips 66 has is that they've been able to source advantaged crude. So that's heavy crude, high quality, and and shale oil. They've been gaining more and more access to that oil, and that gives them somewhat of a competitive edge. In fact, 66% of their refined oil is considered advantaged. And one refinery that they have in, I believe it's New Jersey, it's called the Bayway Refinery. They were able to sign a 5-year, 90 million barrel contract to transport shale oil to the New Jersey refinery. Now, one of the challenges that a lot of refineries have been facing is transporting a lot of the oil from, I think it's North Dakota and other areas where you extract shale oil that aren't close to refineries in the coast. The challenge is to actually get that oil to the coastal refineries because historically we haven't been very large crude producers. So now that that's happened, our production has outpaced our capacity to transport that oil. And few refineries have been able to access that oil. Phillips 66, through their Bayway refinery, has been able to do that. They were not only relying on pipeline, but also rail and any type of any mode of transportation that they could get, because the returns are just very high. So one thing that really stands out in the stock chart, the WTI Brent spread. It's actually I'll start with this. WTI Brent spread, if you can see, it's very volatile. What's happened is that ever since we started producing shale, a lot of the you see the difference between WTI and Brent, it's been widening. And actually, historically, WTI has been trading at a very modest premium over Brent. And that's reversed over the last few years. Now, in the summer, so around, I believe it was late July, you see that WTI Brent spread turned negative, which means that WTI was actually more expensive than Brent. It was negative for like a day, and it was only a few cents. But what happened is that you don't see a huge dip. You see a modest reaction, but it's not very significant. And that kind of tells you that investors have a lot of confidence in this company, and they believe that it has more going for it than simply its refinery business. And that was actually proven in the third quarter results. So risks, of course, like I said, it's a refinery business. They have their largest costs are crude oil, and that's the main risk. We all know how volatile oil prices can be, especially when it comes to geopolitical tensions in the Middle East. The company has accumulated a massive cash holding, roughly over $6 to $7 billion. That's been growing quickly as well. Now, they haven't mismanaged it yet, and in fact, management has been very, very prudent with capital. A lot of C-level executives were actually started as sales or engineers in Phillips 66 20, 30 years prior. So they know the business very well. They know how to manage it, and they have, you can say, a vested interest in the company, not only financially, but because they've spent so much time there. Another risk, and that's actually what we saw in the summer, is that when you have a lot of the transportation infrastructure built, and you have that diminishes the competitive advantage of refineries who have access to the oil that other refiners didn't have access to. That will diminish a lot of the margins. Phillips 66 follows, I forgot to mention this, a 3 to 2 to 1 crack spread, which means from 3 barrels of oil, you make 2 barrels of gasoline and 1 barrel of diesel. So that's generally a good gauge of margins. Now, when we develop the transportation infrastructure and that competitive advantage diminishes, you'll see margins continue or begin to shrink. And actually, in the third quarter, the refinery business lost money, lost $2 million.
2 minutes.
Well, my sell recommendation is actually an ETF. It's the SPDR DB International Government Inflation Protected Bond. It does not include U.S. Treasuries, though. So I looked at the top holdings of this ETF and found the countries that they hold their bonds of. You have France, Japan, Britain, Poland, and South Africa. Those are the top 10 holdings. So I looked at what you would look at if you wanted to protect yourself from inflation. If you see average CPI from January through September, that's the first row, you see, with the exception of South Africa, it's very, very low inflation. In fact, there have been instances where inflation was negative in some months. And then you have to see, all right, well, what could drive inflation? One of them, demand. And how can you gauge demand? You see GDP growth. And that still has been lackluster. France was in first quarter of 2000. These are all 2013 numbers. First quarter of 2013 across the board, hardly breaking 1%. Japan being the exception. And of course, we all know the drivers of that Japanese monetary policy. And then the second quarter, you see kind of the same thing, modest pickup, but still hardly breaking 1%. So you have to ask yourself, should we be looking for inflation protection right now, given the economic fundamentals? So the sell thesis, if the Fed eventually begins to taper, it will impact all fixed income securities, including developed countries. And that's what we actually saw when there was a scare in May when Bernanke said that he might begin to taper towards the end of the year. GDP growth, lackluster. Many central banks in a lot of these countries, developed countries, have been pursuing unconventional monetary policy.
Questions? Could you finish your self thesis?
Thanks. Good question. The last point is that we're in a period of fiscal deleveraging, so we shouldn't expect very high inflation. Anyone want to ask?
Any other questions?
Sure. So,
Yeah.
I know Phillips 66 recently divested their power operations. Could you, if you know about that, could you talk a little bit about that and what it means for its overall strategy going forward?
Sure. So the power operations, their main line of business is refinery. So they have 4 segments. Well, three revenue generating segments. You have the midstream segment, which is pipeline. They recently launched an MLP that went public in September. And then you have the refinery and marketing, and then you have the chemicals business. That is not a core business, and that may be the reason. Now you have to understand that Phillips 66 was spun off of ConocoPhillips. So I actually didn't come across that, but it wouldn't surprise me that they would spin something up that's not core, a part of the core business. It may have been a legacy of their being under the ConocoPhillips umbrella.
Other questions? Not. Thank you. All right. Does everyone have one of these? The voting sheets.
I've been writing notes on it.
All right. So vote. The first 5 have already been done, so you don't have to do it. Vote and then put the tallies up here when